Welcome back, everyone. And here we are for our final session of today on growth through acquisition, the buy-side overview and insights panel. We really appreciate all of you joining us, whether this is your first session or you've been with us since the start. Now, just as a quick friendly reminder, we do suggest clicking into your gallery view for the best viewing experience today. And as a reminder, we are going to be opening up for live Q&A at the end of the session. So be sure to put your questions into that Q&A box that you'll see down at the bottom. And please remember to submit your questions whenever they come up during this time today. Now, we hope the information provided by our experts in the previous panels and so far has been timely and valuable. And we look forward to staying in touch with you as your growth continues in this journey. If you're interested in booking a meeting with our partners, as a reminder, you can do so by clicking on that link that you'll see pop up in the chat box. And as you said, Lynn, we're asking for one more participation in one more poll today. And that is, as we look into 2021, a curiosity to understand how many acquisitions you're actually planning for in the coming quarter. So I'm going to go ahead and launch that poll right now and just invite you, if you will, to take a moment to share this with us. It'll help all of us understand and our panelists understand today the volume of activity that you're actually looking for guidance on over the coming quarter. I'm going to give everyone just a moment to respond to this. Your options obviously are, we're not right now, looking at 1 to 3, maybe 3 to 5, or more than 5. Interestingly, the majority of our participants so far are falling in that 1 to 3 spectrum, with about 55% hovering around that right now. So let me go ahead and end the poll, just quickly share those results, and then we are going to go ahead and get started with this great content. So as I get ready to introduce the panel today, again, a major amount of thanks for all of you joining us. But without any further delay, please join me in giving a very warm welcome to our guests for this next session. Our moderator today is going to be Saran, Vice President of Corporate Development at Viacom CBS. We have John, Managing Director at KPMG, Melissa joining us as a member of Wilson Sonsini's team, and Yolana, Transactional Insurance Executive, M&A at Woodruff Sawyer. Panelists, thank you so much. Everyone joining, trust me, we're going to learn a lot together over the next hour plus. Over to you, Saran. Thank you.
Excellent. Thank you very much. And I'm delighted to be here today and be joined by this wonderful group of panelists, and looking forward to hearing from them today. I'll introduce myself quickly. Saran Tanilian. I'm a VP in Corporate Development at Viacom CBS. I focus on all things capital related, acquisitions, mergers, investments, JVs, etc. I've spent about 6 years at Viacom CBS and previously was in investment banking for some time. With that, I'll hand over to John.
Yeah, good afternoon, everyone. I'm John Milner, and I'm a managing director in KPMG's deal advisory practice. And so I advise my clients throughout the M&A transaction. And while I'm primarily focused on the pre-closing activities, including due diligence and the like, we'll also quarterback our efforts in our clients' post-close to help them execute on their value creation thesis. And I work with both private equity and corporate and strategic acquirers, primarily focused in the technology sector. And within that, a portion of my practice is supporting growth equity investments. So you're kind of CD when you start getting some of those institutional investors there. Excited to be here today.
I'm Melissa Hollitz. I'm a partner at Wilson Sonsini in our corporate M&A group down in Palo Alto. Been with the firm my entire career. I have a relatively broad-based corporate practice, but the main area of focus for me is representing serial acquirers, mostly on the public company side, but I have a few large private companies that are serial acquirers as well. I'm very happy to be here today.
Hi, everyone. My name is Yelena Dunayevsky. I'm a corporate finance and M&A attorney with prior experience representing companies and in their capital raising and M&A transactions. And as an insurance broker at Woodruff Sawyer, I use my legal expertise to help my clients find the best possible solutions for their insurance needs on the M&A side. I have a particular interest in SPACs and specialize in that area, and that is a topic that we'll talk about later today. And I also frequently contribute articles to various publications, including ABA, Law 360, Bloomberg, and the like. And for those of you who are not very familiar with Woodruff Sawyer, it's one of the largest independent brokerage firms in the country with 17 locations in the US and Europe. And we specialize in M&A management liability, including IPO and cyber insurance. Happy to be here today. Thank you.
Thank you very much. And why don't we go ahead and kick it off? I mean, clearly, 2020 has been a fairly tumultuous year so far. And just as many things in our everyday life have changed, certainly M&A hasn't been spared. And so I think it's difficult to discuss M&A today without kind of that broader overlay of what's going on in the ecosystem. So I guess on that note, why don't we start with you, Melissa, and just chat a little bit about your perspectives on kind of which industries have gained interest in the current climate more so than others, and whether those industries are fairly aligned with kind of the industries that are performing well amid the pandemic.
Sure. Yeah, I know there was a panel earlier in the day where they went through a lot of data around the various industries and what was doing well and what wasn't. And I will say anecdotally, I won't cover that again, although I will say it seems like great information. I will say anecdotally, my practice certainly agrees with those approaches. So my practice is primarily in the tech sector, do a little bit of life sciences as well. And within those sectors, so certainly software is doing incredibly well. I think you saw that in the numbers before. But I will say, sort of stepping back, I mean, there are the macroeconomic trends, which I certainly agree with what was presented there. I will say there are clear winners and losers in the current environment. And I will say, interestingly, I do think you see M&A activity on both sides. Disruption in general is good for M&A. You have some winners, and if people are doing well, they need to accelerate their growth, they need to increase their talent, they need to build out their customer base, their technology base, and so you see them being acquisitive. And frankly, if industries aren't doing as well, or sectors aren't doing as well, they need to do M&A too, because they're trying to find ways to keep afloat. They're trying to get out of a business if they can't be there anymore. And so I will say you do see activity on both sides of the spectrum.
That's a very interesting perspective, and certainly resonates with what we're seeing out there as well. John, Yelena, how's your experience been here?
John, you want to go first, and then I'll round it out?
Yeah, I largely agree with Melissa. I mean, I spend most of my time focused on technology, and I'd say it's been an incredibly active sector over the last, call it, month and a half after everything sort of died down during the pandemic. But I agree, there's activity on both sides because there's a number of areas where there is distress and they're coming to market. I was talking with some of my colleagues that focus a little bit more on kind of quick service restaurants and something outside of my wheelhouse, but we're seeing deals get done in that sector as well. Some of them are distressed, some of them aren't so distressed. And so I think it really kind of depends upon where they are, but the disruption, as Melissa mentioned, really helps drive a lot of M&A. I think technology's been a leading sector.
And on our end, so from the insurance perspective, I'm looking at it from deals that are using representations and warranties policies as they're acquiring and merging. And for those of you who are not very familiar with reps and warranties, it's an insurance product that is a bespoke kind of a policy that you can place into an M&A deal. It allows basically for some risk to be transferred from the parties to the insurer, and protects against breaches in the purchase agreement. And so from that perspective, we've seen a complete slowdown in the beginning, sort of in the spring, where there was just no deals were happening at all. I think everyone was in shock. And then once everyone kind of figured out, okay, this is what we're going to have to live with going forward, it was just a free-for-all. We had so many deals happening in the summer that I can tell you this was the busiest summer I've seen, and I think I'm not the only one. I saw some reference to Financial Times describing it as the busiest summer on record for M&A. So that activity is still happening. We're seeing a lot of deals going through. The dynamics have changed a little bit, I must say. So we saw a lot of more smaller deals coming down the pike in the summer and going into the fall. Perhaps due to people, some companies divesting portions, and then some of the larger deals took a lot longer So they were, either taking a lot longer to do the diligence, perhaps because they were now having to do it remotely, versus how they normally do it. But so some of the normal dynamics kind of got shaken up a little bit, and that's what we're still sort of seeing in the market.
Yeah. So I guess following up on that thread, and John, if I could turn it over to you for a moment. How have you seen cross-border activity fare in the current environment? And are you seeing sort of a difference in terms of cross-border activity in the U.S. versus the EU, just given relative travel restrictions, et cetera?
Yeah, I think it's actually been really interesting. You obviously saw a massive decline in kind of global M&A in Q2 in the first half of Q3. I think everybody appreciates that. And Elena's comment about the busiest summer was we think about kind of August and September. I'd echo that. And I see that both domestically, but also on the cross-border deals. And I haven't seen a whole lot of cross-border deals in the last, call it kind of 2 months. I've been involved in 3, 2 in Europe, 1 in Asia. And kind of in all 3 of those instances, I would say it was, business as usual in the new norm. And the new norm is obviously very different, but they're adapting in the EU or in Europe and in Asia, much the same way we are here to deals. And I think the biggest difference is the fact that we're all getting used to being remote, which if I think back to prior cross-border deals, we would have been on planes, our clients would have been on planes, we would have had people flying all over the world. And now everybody's sitting in the comfort of their home office or desk or wherever it happens to be. And we're all accepting that. And I think that that's been a really interesting trend, because I would have thought that would have actually slowed deals down, but without the travel and the other logistics and people being able to jump on calls and the like, I think it's actually keeping pace. So that's been somewhat actually pretty interesting there. I think what that's actually caused, though, is a change for the investor. So, and kind of that going back to my relatively small sample of, call it 3 that I've been involved in lately, 2 are corporate, 1's private equity. The corporate ones moved smoother. And I really attribute that to the parties having known each other. They are in the same markets, they're competitors, they've been partners. So there's a familiarity there on a personal level with the principles of the deal. Whereas when you think about the financial sponsor world, that tends not to be the case. And so you're still getting over that hurdle with them for the private equity investor saying, am I really going to put X dollars into this investment, having never met the person and knowing that that person is 10 time zones away? But they're getting over that hurdle. And so I think going forward, this may be a sort of a new norm where we actually see more sort of these transactions because it becomes easier to do remotely.
Yeah, that's interesting. Would you say there's some components, just following up on that point, are there some components of deal making that buyers are still viewing as must have, call it a site visit or something that is physical? Or have you found that on the buy side, there's some buyers are willing to live fully within the sort of the new normal?
I think buyers are starting to really learn to live with the new normal of never having done a site visit. And I think it really depends upon what you're buying. I mean, again, most of my clients are software vendors. So what are you going to go see? You're going to go see a fancy office with some free food and some snacks and the like. And it's a little bit different than if you're going and buying restaurants, or if you're going and buying a production facility where you actually want to walk the floor and you want to see the machinery and that it's there. And so I think it does depend upon a little bit in terms of what you're buying there. But I think a lot more people are getting used to being remote. I still think there are the times when the principals are going to get on a plane and go shake the hand and walk the plant floor, and it'll be a small group or something else. It won't be flying in these armies from everywhere. But I think people are really getting used to it, which I thought wouldn't occur, but it is.
It's been amazing. Absolutely. Well, so I guess on that point, I mean, I think certainly it's an interesting a concept that's been brought up around the fact that, you kind of have almost the barbell of industries and companies that are doing very well and feel empowered to do M&A. Some that have been in industries that are have been hit harder in the current times, and perhaps they're doing M&A out of necessity. And then you probably have that middle ground of perhaps some that are a little bit more hesitant, maybe have pressed the pause button for a few months in terms of pursuing buy-side activity. And I guess, Yelena, turning to you, What advice would you give to the folks, both kind of strategics and private equity, that are thinking perhaps I slow down for the time being, given everything that's going on?
So great question. I mean, I've seen it really kind of still, it all depends. I'll give the lawyer the lawyerly answer. It really depends on the industry you're in. Like John was saying, there's a lot that has to do with that. So we've seen problems come in with diligence, right? So from where I'm sitting, when the reps policy comes into play, you have an additional set of eyes from the insurer taking a look at the diligence that the buyer is doing, right? So if you're, as a buyer, I don't want to say cutting corners, but doing the diligence in a different way than you were doing previously, you're going to get a lot of those questions from the insurer saying, well, did you really go to the site and see all of the, X that's there? And does that look to be what you were looking for? And so that kind of puts a little bit of a strain, I suppose, on the parties performing the diligence. And I can see a little bit of hesitation if you are looking for a target where you have goods that you really need to examine in person, and you can't deploy your typical team over the typical team over to the sites, especially if there's international or jurisdictions that are difficult to get to. I can see a little bit of hesitation that I would say would be warranted, because you're just going to come across a bunch of these issues down the road. But on the flip side, however, like John said, everyone's kind of gotten used to doing business the way we're doing business now. And I must say that the insurers have really adapted really well to being flexible, understanding that parties are running into some of these issues on the deals. I must say the competition from the insurer perspective has been very robust. So if you are looking, if your hesitation as a buyer it revolves around whether or not you're going to be able to get the same kind of support on the insurance side, I would say there's no reason to hesitate there. There's still 22 insurers out there that are more than willing to write those deals for you, and kind of help you along the way. So I would say the coast is clear, at least from that perspective.
Great. And Melissa and John, anything you would add on that topic before we move on?
No, I would agree with everything Yelena said. Uncertainty is often bad for M&A, but uncertainty is the new normal. So I think people don't have the luxury of waiting until the world comes back to a normal state again. Yeah. And I will say, and frankly, this is one of the things I love about Silicon Valley is the pandemic hit, the world turned upside down, and everyone sat around for a couple of weeks and then got bored and said, we have stuff to do, like, let's get back in there and keep going. And on the whole, that's sort of what it's looked like. Which is kind of extraordinary.
That's great.
Yeah, I agree with both Melissa and Elaine on that. I mean, I think that not only have the world figured out how to deal with this, but it's accelerated lately. I mean, I think if you're a buyer thinking about being a buyer and you still think you need to sit on the sidelines because deals aren't being done, that's just not really the case right now. You know, the hesitation shouldn't be, there's nothing for me to be looking at. It should be, am I figuring out the right price to pay? Am I doing the right level of diligence? Am I building the right protections in? Because there are a lot of deals, and if you think that it's not happening, it's just going to pass you by right now.
So in that context, I mean, interesting you bring that up. So I guess in that context where you do have certainly a lot of opportunities out there, and if you are a buyer who is continuing to be active and ready to seize those, what are you seeing in terms of the criteria on which deals are being evaluated, or the metrics? Have you seen those change in the current environment versus what one may have buyer may have looked at last year?
Yeah, it's a really interesting question, and I'll talk about it kind of from a technology, a software lens, as it's what I'm most familiar with. But I would say the metrics and the way that I'm seeing buyers evaluate businesses, that's not changing, right? Buyers today are still thinking about what is happening in my bookings growth, my cross-sell, my upsell, what's going on in my ARR, my retention rates, my customer acquisition costs, lifetime value. All of those are still very key metrics as they're thinking about the business. But what I actually think is changing is the way that they're looking at those metrics. So the metrics hasn't changed, but maybe a little bit more around the way they're looking at it. And I think we've started to see that in our practice at KPMG with some of our clients and have been adapting, and we're kind of really thinking about it in kind of a different lens. And I think about why for kind of three main reasons here. First, you've just got still a lot of macro uncertainty in the market. And so clients and buyers that would look at higher level market analysis, thinking about the competitive landscape, thinking about the customer demand patterns, a lot of those analysis and everything that they would have done is probably outdated by now. It's just somewhat not relevant with the disruptions that's happened. It's moving faster than that. And so that's one of the reasons. Second is there's just a lot of change in underlying company performance, right? We've talked about it. We've heard about it today. Some are really being really successful. Others are not. But every company that I've looked at over the last few months has had some level of impact because of COVID and the current environment. Right. And whether that's top line, cost base, cash flow, it's just changing the way people are doing due diligence there. And I think third is around the valuations. I mean, they're high. So people have to figure out a way to justify and have certainty, and maybe certainty is the wrong word there, but at least conviction in their thesis behind why they're doing this deal, right? And so with those kind of factors at play, I think people are really digging down and saying, what is this company's right to win in the market? So if I used to hire, Bain or BCG for a big market study, maybe I'm still hiring them or somebody else, but what they're doing is different. We're creating a more proprietary view on the market because that's how we're going to get a competitive advantage against another bidder here. I see them going deeper in the analytics. So where we maybe just looked at overall bookings trends, overall retention trends, et cetera, we're now diving much deeper into the transaction data. Buyers want to understand, well, how do I slice and dice that based upon product, geography? And not just looking at retention, but how do I look forward? And how do I build sensitivities and scenarios into my modeling? And so, if I could take an example here, most software is sold on annual or multi-year terms. You might not see any disruption today, but the next 1, 2, 3 quarters as those come up for renewal, what's going to happen then? And we used to just kind of look at it and say, well, historical trends probably prevail, but that doesn't really work today in the current environment. And so it's really about saying, well, who are those customers? And how do we assess the risk of the end customer for renewing versus just looking at trends? And so again, it's kind of going deeper. It's more granular in the analytic perspective there. And I think the last point that I'll mention is just around being cognizant and preparing for what the future operating model looks like. I think a lot of buyers think about the metrics I mentioned, think about what it means today from a modeling perspective, but don't think about how to actually execute on that and what their kind of combined organization looks like in the future. And is that really the optimal structure to be operating on? So I think that's another area where I'm seeing my clients, and especially the ones that are winning, are taking a different view and saying, here's how we're going to be better and more effective and efficient in order to be able to pay the valuations today. So I mean, kind of summarizing it into those three buckets or so.
No, it's that's very, very interesting. Do you find that there's a more of a tendency to look for now companies that may be profitable or have a much more defined path to profitability? Has there been an impact on kind of earlier stage companies based on what you're seeing, or do you find that the fundamentals of kind of the business model and their ability to retain customers and kind of have a recurring business model support even kind of the earlier stage companies?
Yeah, I think you're seeing a little bit of both dynamics. I think over the last year or two, you've seen a trend where buyers have gotten away from negative unit economics that don't have a clear path forward to positive unit economics. Where before you could kind of have anything, and if you were getting demand and you were growing the pie, you kind of get a valuation. I think a lot more people are saying, how do I get to unit economic profitability? And if you're not already there, I think that there's a lot more scrutiny on exactly how you're going to get there. I think there's a lot more willingness to accept losses in the kind of fixed cost base, although it's not fixed, but in that kind of operating base. But if you kind of got the unit economic profitability and can show growth, I think that's being more receptive. It's the companies that don't have unit economic profitability, and the path to unit economic profitability is more challenging.
No, that makes perfect sense. So I guess just following along this line, I think we that sort of addresses kind of how buyers are are thinking about the financial business side of it. Maybe moving on to the legal side of it, and Melissa, turning to you. What have you been seeing from a documentation standpoint? Or have there been sort of newer provisions popping up in legal documents to take into account the current environment and the uncertainty? Or maybe prevalence of provisions that were less common last year?
Frankly, not much. I mean, which makes sense on some level, because when you think about it, writing a definitive agreement is all about allocating risk. So we were already building in scenarios for the founder getting hit by a truck or the IP suit right before closing. Right. So having a pandemic hit isn't frankly all that different from what we hardwired in before. I will say the universally beloved material adverse effect clause, which for those of you who aren't lawyers and don't love law, is sort of the how bad does something have to be before we think maybe you don't have to move forward with the transaction, is subject to some standard carve-outs. And one of those carve-outs that has become, as you can imagine, very standard is a effects of COVID clause. There was always acts of war in there. Those have gotten built out into increasingly paranoid scenarios. And while they were heavily negotiated at the beginning, I think on the whole, it's become pretty widely accepted to add that carve out. It's also frankly less pressure, because for the first couple of months, people didn't know what this disruption was going to mean. And at this point, generally people have a sense about what the effects are. So buyers who are contracting now have seen a lot of the effects play out already. But you do see the material adverse effect definition change. You do see there are restrictions on conduct of business between signing and closing. Often sellers are asking for more leeway there than they used to. Buyers like to lock them down very tightly. And sellers are a little less comfortable with that now and feeling like they need a little more autonomy to deal with the effects of COVID. One thing that's been a little bit of a huge pain, frankly, and has added a lot of uncertainty to deals are PPP loans. So the CARES Act loans, those, they don't stop transactions from happening, but they are very common. They are a moving target. People are still really trying to wrap their arms around how they work, whether they're able to get forgiven before the transaction occurs. A lot of large buyers have reputational risk, so they don't want to assume the loan, even if it's technically possible. And there's this whole layer of technical requirements beyond that that also makes it difficult to assume them. So you can go very deep down into a rat hole on those, but I will say 75% of the deals I'm doing right now have a PPP loan in play, and it adds some complexity and it adds some discussion. So that is certainly something that has been new and different and challenging. And then there's just some funny little mechanical issues. So for companies that still have physical stock certificates, which happens, I have sellers who say I have it in the office, but I can't get to the office. And so we have to figure out what to do with that. So there are just some smaller logistical issues that we've had to be creative about navigating. But backing up big picture in terms of the risk, it's been not as much as one might think initially.
It seems to follow that sort of theme of folks adjusting fairly quickly and things sort of remaining more normal than one may expect. So along those same lines, maybe Yelena, turning to you and just focusing in on reps and warranties in 2002, kind of, what are you seeing that's changed on there, and how's that impacting private companies?
Sure. So reps and warranties, is this product that I mentioned, very instrumental in a lot of the deals that are happening on the private M&A side. Of course, I think it's used in about 75% of deals driven by private equity, and I believe, by 50% or even a little bit more of all private M&A deals. So it's a product that's been around for a bit and has proven its efficacy. So in terms of changes during 2020, I would say there haven't been too many major changes, but similar to what Melissa had mentioned previously, the big change was obviously around COVID. And so what happened when COVID hit, the insurers panicked like everyone else and slapped on a blanket COVID exclusion onto the policy. And to back up a little bit, so the policy that gets issued typically has a set of standard exclusions, normally dealing with things like asbestos or I don't know, known risks or underfunded pensions. Those are typical. But when COVID hit, the insurer said, oh, wait a second, we don't understand where the risk is going to be coming from. We could potentially be hit with some serious issues here. So let's exclude everything relating to COVID. And so that was a little bit, I would say, dramatic. And they got a lot of pushback, as you can imagine, from the participants in the market, from the brokers, from the attorneys, who basically said, look, I mean, you're basically saying that with this kind of an exclusion, anything can go within the realm of the COVID exclusion right now, the way that you're drafting it. So that kind of makes the policy almost worthless, right? So the insurers, took a step back. They realized that this is not really going to play out in the market very well, and they've started adjusting. And they actually adjusted fairly quickly to the point where a lot of them started saying, look, we're just going to start working with the particular deal, look at a particular risks related to that transaction, look at the target, its business, and see how COVID impacts the particular business. And we would still exclude items but related to COVID, but not just kind of have this blanket exclusion in place. And that has worked really well. Right now in the market, some insurers have narrowed it down so much so that basically the only thing that are excluded are the target being responsible for like infecting people with COVID. So that's pretty narrow. Right? Most of the companies have, processes in place to avoid doing that. So so that's that's pretty narrow, and that's allowing the market to move forward, and for the typical process around this policy and this product to continue. And I think that's going to be true going forward. I do want to say though also, so that's sort of the main change that I've seen in the market in 2020. The other change that I would say is not huge, but kind of slowly creeping in the direction of being significant, is that in the product has matured over the last few years that it has been used, and there's some studies that came out recently focusing on claims. The claims have been going up a little bit, and so there's been an increase in severity and the number of claims, and as a result of that, and not perhaps just not only due to additional risks brought on by COVID, but also to the fact that there have been more claims in the market and the insurers have been paying them. There's a developing trend of insurers potentially increasing their premiums going forward. Not drastically, but I think that's where the market is going, and also potentially limiting some of the terms that they have come to cover.
Okay. Very, very, very helpful. Thank you for that. So, just I guess moving on from there, and maybe I'll turn to Melissa next on this one is, I think this was mentioned earlier in our conversation, and there's sort of the notion that some deals are getting done quickly and some are dragging on or not happening at all and are kind of getting disrupted. I don't know, Melissa, if you're just kind of seeing a trend, or if you have a hypothesis around kind of what's leading to some deals not getting completed versus others.
Sure. Yeah, I would say I've seen all of the above. I think there are I think there are some acquisitions where it is difficult to scope the risk. It is difficult to do things remotely. People are bandwidth constrained, and they're just moving more slowly. And so I think some deals that took a while before are taking even longer to do. I think it has always been the case that there are some acquirers who just pride themselves on moving quickly, who sell themselves as moving quickly. And in this competitive environment where they're trying to get deals done and they're trying to convince a seller to go with them, they tell them they can decrease uncertainty by moving quickly. And so they are being forced to move even more quickly. So there's a little bit of a, so Yelena's earlier point about hold your nose and kind of cut some corners on the diligence and just take some risk and move forward, I think you see some of that too. I think time always increases uncertainty in the process. And so everyone, M&A by its nature moves at breakneck speed. It always has, it always will. And I think, I think the trend here has gone all over the place. And so the deals that were getting done quickly before continuing to get done more and more quickly. I do think there are some deals that are slowing down. And I think there are some deals where there is so much uncertainty or things are so much of a moving target that deals fall apart. And I would say anecdotally, I see a little more of that happening now. I think as people are juggling competing priorities, as they're maybe a little cautious about making big bets, I think people are more likely to find something that they're not comfortable with and decide to walk away from the transaction as well.
No, that makes sense. Maybe curious, John and Yelena, if you're kind of what your experience has been in this area, if you've seen sort of a specific trend around the deals that are maybe have you found to be harder to kind of get across the finish line?
I think a lot of deals have come back. Sorry, go ahead, Yelena.
No, you first, and then I'll go.
I think a lot of deals went on pause and have come back, and I think deals are moving forward. I think there's a lot of reasons why things take longer, and I'm seeing it be more unexpected processes. So we can't get data, or like Melissa said, something's in the office and somebody can't get in there. There are those sorts of things, somebody had to go on holiday or take care of their family member. There's always some reason why the process gets dragged out a little bit, and they're kind of unexpected, that are just in the moment sort of items that are happening right now. I don't see that as a systemic item. What I actually do see happening though right now is, with the valuations being so high, I think there's a lot of sellers that have come to the market with assets that aren't worth it. And they try to run a process, they try to move fast and say, here's the lipstick on the pig, if you will, and try to run a really aggressive sales process. And I see a lot of those deals start to fall apart because buyers, while they realize it's competitive and they want to get deals done and the like, they're also not stupid. And so they're seeing this happen. I'm seeing more deals fall apart because there was an entirely different set of expectations between what the seller thought the value was and what the buyer population thought the value was. And those were very fundamental things that aren't COVID, aren't current situation. It's just the heightened valuations have brought those assets to market.
And I would say I haven't seen that many deals fall apart from where I'm sitting, but there was one good example where like John and Melissa said, there are some corners probably cut on the diligence. And what happened with that situation, and the buyer wanted to move really quickly. The seller was definitely willing to do so. When the insured got involved and took a look at the diligence that was done, they asked a bunch of questions, and the buyer realized that they actually hadn't looked at everything that they should have looked at. And they scratched their head a little bit and said, you know what, we're going to have to walk away from this because there's just too much risk. So in that situation, I thought actually I was kind of proud of the insurance product because I said, look, there's an extra benefit. What if this hadn't happened? You would have bought this pig with the lipstick on it, right? And then you would have been, right? Like, where would you have been, 2 months from now? So yeah. Anyway, so that was an interesting example, but what I've seen, I think, and I'm curious to see what John and Melissa think about this, additional emphasis being placed on the cyber protection that the target companies have, especially with the additional risk around all sorts of schemes relating to COVID and data breaches and so on. Insurers have really been very interested in looking into the cyber protection of the target, the underlying insurance there, and the processes of the target, and that has, I wouldn't say derailed some of the deals, but it just put an extra pressure point on those deals. So that's one point, and then the other pressure points that I've seen were around international. A lot of international operations, employees in international locations, and especially customers. Customers is the uncertainty around retaining customers post-COVID. So those are the issues that have been popping up lately and are, I think, exacerbated by COVID.
No, absolutely. So I guess just as please.
Oh, I was just going to say the cyber point, I think, is actually a really interesting point. I mean, I've seen it over the last couple years. More and more buyers want to really dig in a diligence phase in cyber. I actually don't know what that means from a legal document agreement. And Melissa, maybe you've got some comments there, but I've seen a lot of buyers kind of have an increasing focus on it. And I think today, with a lot of the things being remote and other issues, that's become a pretty big issue that buyers are looking at much harder in diligence. But I don't know what it means in terms of an agreement.
Yeah, no, I think that's a great point. I would even broaden that to regulatory issues generally. I think 5 years ago, people sort of didn't care as much as they probably should have about regulatory issues, and often didn't take them very seriously and didn't pay a lot of attention to them in diligence. And now, privacy issues are huge. Cyber is as a subset, as you said. CFIUS, like the export controls, FCPA, like all of those issues where I think, frankly, startups got a little bit of a buy in earlier days. There's a lot more pressure on companies having been thoughtful about what they were doing, and buyers really trying to understand and mitigate risk in those areas. So I think we started with fulsome representations in the agreement and just letting people say them whether or not they were true. And now I think there's a much more thoughtful approach, where in diligence we're having subject matter experts come in and really look under the hood and scrub the information in much more detail. And those issues are getting flagged with a much higher degree of urgency than they used to. So I think that's a great point.
So then I guess maybe looking out into next year, 2021, and perhaps looking at our magic 8 balls. So what's your prediction around what happens with M&A next year? Maybe I'll start off with John, but would love to hear from everyone on the panel.
Yeah, I'd like to say this probably sounds crazy, but it probably doesn't. I think 2021 is going to be a good year for M&A. I think 2020 is going to finish off really strongly. I think you've got, pent up demand, but I also think you've got a lot of deals that are trying to get done by the end of the year. I mean, you always kind of have that from a tax aspect. I think the election is throwing in a lot more concern around getting something done before the end of the year. But I've been doing this a long time. Those deals always slip, or not all of them, but a good portion of those end up slipping into January, and people start reassessing everything else once you've kind of crossed December 31st for those reasons. So I think you're going to have, a good start to 21 for that. I mean, if I look across our business, we also help on the sell side, and that tends to be a leading indicator. I mean, we're looking at things 3 to 6 months before they're out in the market, out in the press and happening, and that business is really picking up a lot. And so that's kind of setting up 2021 for, I think, a really good year too. And then just kind of stepping back at a macro level, I mean, debt's cheap. It's going to remain cheap. That's going to keep the financial sponsors, the private equities in the market for a while. I think about cash on the big public corporate balance sheets, particularly the tech companies. There's a tremendous amount of cash that they have to deploy to do acquisitions or do something else. And I think maybe, lastly, we talked about that. Some companies are doing really well, some companies aren't. And those that are doing really well, where you had this massive acceleration in terms of a digital transformation for their business, they've got to go secure that position in the market. They've got to build that moat. They've got to figure out what are the adjacencies that I'm at risk, and how do I fill in my competitive holes, whether it be product or customer or geo. And I think they're going to start looking for acquisitions to fill that in because they've just been handed a great leap forward and they don't want to waste it. And on the other hand, you've got the companies that haven't been so successful and they're looking out saying, well, what's my organic growth plan? And it just isn't looking great. And so they know that the only way for them to meet investor expectations is to have that inorganic growth. And so I think both of those causes are going to drive a lot of M&A in 21. And I think, again, the valuations are giving a lot of companies great currency to go out there and use and buy, in addition to get cash and the debt. So I'm actually really bullish on 21. I don't know if it'll be as good as 2018, which I think was maybe the peak or recent peak. Maybe it's as good as 2019, which was, almost as good as 2018, but I think it's going to be a good year.
And it's actually, thank you for raising that point. One of our audience participation questions was around the interest rate outlook and the impact on M&A from the buy side. So I think from it sounds like sort of the general perspective from your side is, you'll continue to see a good interest rate environment, and that will kind of drive partially to some extent the outlook in 2021 as well.
Yeah, absolutely. I mean, I don't spend a lot of time in the capital markets dealing with the specific interest rates, but when I talk to my clients, especially on the private equity side, debt continues to be very affordable. There were some questions around how many multiples or turns of EBITDA would people lend on, and I think they tightened up a little bit, and some of that's coming back lately. So you're, not only cheap, but it's still pretty available for most deals that look good. So I think that the cost of doing a deal is going to continue to remain relatively low if you think about it from a debt perspective, or in not inflated but high valuation of equities to go use as currency.
Right. No, absolutely. Melissa, is your thing consistent here?
Well, I will admit, I actually thought 2020 would fall off a cliff in a way that it didn't. So I'm not sure my predictive skills are worth anything, but I would echo. But I would echo what John said. That all seems reasonable to me. I will say it also depends a little bit on who the nature of the buyer is and what they're buying. So financial buyers are very sensitive to debt rates. A lot of strategics don't care really. It depends on if you're using stock or cash as currency, versus trying to do a debt financing on a deal. So I would throw out that I think there are a few other factors that also sort of complicate the analysis around it. But again, for me, things are continuing to move quickly. The pipeline looks strong, and I agree 2021 feels like it'll probably be a pretty strong year.
I would agree with all of that. I think after the election and perhaps the end of the year uncertainty settles down a bit next year, from where I'm sitting is good to go. I think there's going to be a lot of deals. From what I'm hearing from my contacts in the market, everyone's kind of geared up in that direction. The only thing that I think might be difficult is, again, the deals in highly regulated areas. Like Melissa mentioned, that's becoming more and more difficult. And I think transactions with targets or parties that are in a lot of international locations, that could, it will kind of bleeds into the regulatory aspect as well. So I think that could be a little bit hairy and tricky in 2021. But aside from that, I think it's a green light.
Wonderful. I'm certainly excited to hear that. As a corporate development professional. So Elena, just sticking with you, and maybe shifting a little bit our discussion on SPACs. I'll admit I'm not the closest to the SPAC ecosystem, but certainly from a more casual view, it does feel like there's been increased activity by SPACs out there. So, how have you seen that, to be the case this year? Have you seen, more SPAC deals come across your desk, and kind of what's the general environment?
Sure. So I can tell you, I can talk about SPACs all day long. I will try not to because we only have a few minutes left, so I'll try to keep it short. But or maybe I'll talk really quickly. But what's been happening, sort of to set the stage for folks out there, what's been happening this year with SPACs is just tremendous, enormous. I don't know what term to use, but all of those terms combined, this has been the year of the SPAC, as far as I could tell. There's been so many SPACs out there doing IPOs. I think in October alone, 45 SPACs already IPO'd. Just to give some numbers and to kind of tie it into why it's relevant for M&A. So 160 SPACs have raised about $60 billion in 2020 already. And there's more on the horizon. And 171 of them are now looking for targets. So just to take a step back, so a SPAC is a special purpose acquisition company that raises funds in an IPO and then has about 18 to 24 months period to spend that money and some additional money that they will raise typically in a concurrent PIPE or some other financing transaction to go out and buy a private company and essentially take it public. So it's basically money sitting there in a trust account waiting to be spent on private M&A deals. So right now there are 171 targets looking for M&A deals with money in the trust is about $60 billion right now. That typically translates into about 180 or so billion in actual money going to be spent going forward in the next 18, or so months. And so that's what we're going to be seeing coming down the road in the M&A field. And I've already seen a number of SPACs looking into, well, at least from the insurer perspective, looking into obviously the reps and warranty policy. Virgin Galactic acquisition by Social Capital last year, used the reps and warranty in their deals. And I think there's going to be more and more coming down the pike, not only because there's just an increased number of SPACs that are going to be looking for targets, but also there's been a shift in the demographic of SPAC sponsors. So whereas up until now, SPAC sponsor teams were coming from various backgrounds, a lot more are now coming from private equity and VC backgrounds. And considering the fact that, reps and warranties products is very widely used in the private equity space, a lot of those guys are now familiar with this product and are going to be using it going forward, or at least that's what I think. And so, and I think that's coming down the road. And so, and the other reasons I think we're going to see a lot more SPACs happening is because they're now they're sort of taking on the way that private equity driven deals are done. Like I've heard of SPAC offs, which I think refer to SPAC auctions. Right? Yes, there is a term SPAC off. Right? Anyway, so that's where kind of things are going. They're looking more and more like private equity deals, and there's sort of this exuberance around this area that I think perhaps is a little overinflated right now. But I think it'll come down coming, into 2021, but I don't think it'll dissipate entirely. And I think it'll actually continue at a decent pace into 2021 and beyond.
So on that note, I mean, for folks, in the audience that are thinking about it from a sell side perspective, and are looking at sort of the SPAC universe as an additional sort of pool of buyers, would you say there's sort of some natural kind of inclination as a SPAC buyer? Are they sort of tend to be constrained by size or the types of assets that they're going to be looking at buying? Or do you find that it's a pretty broad sort of mandate that's out there?
It's a pretty broad mandate. I mean, when a SPAC actually raises funds, they have to specify in their disclosure, what industries they're going to be looking at for their targets. But a lot of them don't focus too narrowly on the industries. They want to leave themselves a bit of room, obviously. A lot of the times the the appetite is driven by the team that the SPAC sponsors consist of. You know, if they have a underlying experience in that industry, that's the industry they're going to be looking and are going to be more successful in for their target. But I've seen them sort of across the board. I mean, there's everything from ed tech to, you know, like biosciences to, you know, lots of them in technical, and, you know, consumer. I mean, you name it, TMT. They're just all over the place. So I don't think it's tied to any particular sector.
Okay, very, very helpful. And then John, I guess just moving over to you. You know, what's been your experience? Do you see sort of SPAC activity in your practice, and kind of what's been the trend there?
Yeah, I mean, I'll echo Yelena. It's been probably an incredible year of SPACs. As I think about KPMG's practice for deal advisory, you know, we'll touch kind of all of the different parties in their different stages, be it a company that's either thinking about going public and we're helping them around kind of that accounting get there, but also the ones that are actually making that decision. Do I want to go the IPO route? And how do I get ready for that? And how do I go be a public company through a SPAC? It's a much different on-ramp to being a public company from just an accounting, a compliance perspective. We're having those conversations every week. We're having conversations with the operating companies once you know, they are acquired, or, you know, in that period where they're before the completion of the transaction and they're figuring everything out. Oh my gosh, how do we now be a public company and get through that? The conversations with the SPAC team saying, how do we evaluate deals? How do we go through that? And then the sponsors that want to say, well, how do I get in on this? And how do I actually go through it? And across all those parties, we're having those conversations. It seems like it's increasing every week, the number of those. So I would say it's very hot. I think it's going to continue for a while. I don't know what it looks like in 3 to 5 years. I mean, I think you've got a lot of money out there, as Yelena said, that needs to be spent in the next 2 years. And but I think there's a lot of forces and trends that are favorable here, right? I mean, sponsors like it. Some companies like it as a better on-ramp for the certainty around pricing and timing to being a public company. And there's a lot of investor demand for it. I mean, this delay of private companies going public has created a lot of demand in the public markets for these type of companies, and any route to get them there, I think there's a lot of demand from investors, be it institutional or retail.
Okay.
Yeah, and I think it's also going to be one additional point. I think the demand will continue as long as the interest rates remain as low as they are, because basically there's nothing else. You have an option of investing in this SPAC that's going to sit there for 2 years, and your money is basically riskless because you can always take it out if you need to, and you will generate potentially a good profit. Or your other decision is where do I put that money for it to sit, accumulating zero interest rate, elsewhere. So I think as long as the interest rates continue to be as low as they are, there's going to be demand in this space.
Yeah, it's a great point. You get the warrants, you get basically riskless cash, and you can get your money back, right, if you don't like the deal. So
yep.
Your bank's not paying you anything unless you've got a better option and you want exposure to the sector. It's a great opportunity.
That's certainly makes sense. And so I guess then maybe Melissa, turning over to you, you'd mentioned in your intro that you do a lot of work with serial acquirers. Is there anything unique kind of as you think about serial acquirers in terms of how they're behaving in the current environment? Anything specific from, as you think about it from the seller perspective?
Sure. I actually did a panel recently with 3 of our clients with Tesla, LinkedIn, and Splunk, all serial acquirers. And I was really interested about how they're viewing things and what's changed. And this will be super consistent with what I've said before, but honestly, they all 3 of them said, we haven't really changed that much. They're disciplined buyers. We know why we're buying, we're either buying talent or we're buying technology or we're buying a customer base. We don't value it all that differently. We're not bargain hunting. And on the whole, serial acquirers tend to buy companies they know, like that are in their ecosystem or they're familiar with. So being remote is less disruptive for them than it is for a financial buyer who is, as John mentioned earlier, is knocking on your front door for the first time. On the whole, serial acquirers often know who they're acquiring. So they were pretty adamant that there are certainly some process changes. They're doing everything remote. There, all of the changes around the edges that we talked about. If the customer base has been disrupted and you're buying for customers, like you're worrying about things like that. But generally high level, they said, we are disciplined. We know why we're buying and how we buy, and it's not different this year than it was last year, and it won't be different next year than it is this year. And so I think it actually didn't change all that much.
Great. And then I guess just the the last question for the panel before we move to more of a wrap up and Q&A. But Elena, I guess turning back to you, do you mind just describing for the audience a little bit of the process around the rep and warranty policy in an M&A deal, sort of what that looks like, and what companies tend to be good candidates for that?
Sure. So the process is fairly painless. What happens is it takes about 2 weeks ahead of the signing of or closing of the M&A transaction. If you're interested in looking into the reps policy, you need to contact your broker. Hopefully hopefully as soon as possible. You don't have to wait until the 2-week period, although we can get it done, of course. But give your broker a call. They'll walk you through it. But typically, they'll need a purchase agreement, a draft of a purchase agreement to market your policy out to the insurers. Once they get the quotes in, they'll walk you through all of the terms. Once you decide on an insurer, you will then negotiate the policy. Each policy gets negotiated for each particular deal. So you'll get your lawyers involved in that negotiation. The broker will help you with that negotiation. And once you get that that part done, while that's happening, your insurer is going to be taking a look at the diligence process that your team has gone through. And so, as I mentioned, that's like an extra set of eyes on the diligence that's been done. So the insurer will take a look at that. That will get folded into the policy with potentially some exclusions if you've cut some corners on that diligence. And then you typically have about a 2-hour call with the insurers to go through any remaining points or open points. That's the way that they get comfortable around issuing the policy and the terms that they're providing. And then at that point, you're basically done, and the policy typically binds at signing of the agreement. That way you have additional protection in that period between sign and close. And there's some post-close subjectivities that need to be taken care of. And then, that's it. You've got your policy there, typically valid for, 6 years. Yep. It's pretty easy. It's pretty easy. And it works along the side of, your usual, the deal that you're running. So it shouldn't really hold anything up, especially if you give your broker a call a little bit ahead of time. And in terms of which candidates or which companies are good candidates, typically, this policy is buy-side policy. So the buyer is the entity that gets the policy for various reasons, including the fact that there's protection against seller fraud if you're on a buy-side policy. And the candidates, I would say you can have any a typical transaction that's in the typical course insured. I would recommend not going too small on the limit that you're choosing for your policy. And by that, I mean going too far south of 5 million, just because that runs into the economics. It just becomes a little too expensive on everyone's from the economics of it. But aside from that, any deals sort of with limits 5 million and above for the coverage, you can do it. And the limit is based, it's basically something that you pick and consider to be a substantial risk. It doesn't have to specifically tie to the value of the transaction, although a lot of folks do tie it to the value of the transaction at about 10% of enterprise value. But that's not a hard line.
Right.
Yeah.
Does it tend to be sort of consistent with how buyers have thought about sort of saying that kind of the general cap, as we think about kind of in a typical transactions, kind of that 10 to 15% type level? Would you say that's
I think
one?
it works sort of to replace the escrow that would have been in the transaction, protecting the indemnity, protecting the buyer, and setting aside some funds in case there are any breaches. So instead of doing that, so you're basically taking out the requirement of having an escrow in your deal by placing the reps policy.
Yeah, makes sense. Great. Well, look, why don't we shift now to just sort of kind of summarizing the key takeaways from the session. Would love to hear from each of the panelists, kind of at a high level based on the conversation, what the takeaways are. Maybe starting with you, John, if you don't mind.
Yeah, I think if there's one thing that I think buyers should take away from at least my point of view here today is that the deal market is still really competitive out there. It's still very active. And the buyers that I'm helping and that I'm seeing win in the market, they're taking a unique point of view on the asset of what that particular value is. And oftentimes that's going really deep in terms of understanding the market, its right to win, and how it's going to win. And that becomes much more important today versus maybe historically when you'd look at the marketing material from the company and figure out what's going around the edges, the pluses and minuses. It's really kind of a whole new retake of what the value of that company is and how you're driving value. So that would be my takeaway. You got to really think about that.
Okay. Melissa?
I would say stick to the fundamentals and resist any temptation to follow trends or stick, or stray from your general path. I think buyers who are, who are disciplined and who know what they're looking for and why they're in the market and what they're trying to do. If they seek excellence will work in 2020 and 2021 and beyond. And I think any panic buying or short-term trends tend not to work out over the long term. I bought a bunch of .com companies and then sold them a couple of years later back in the original bubble. And I think time and time again, companies who've been really thoughtful about, sticking to their fundamentals and sticking to their disciplined approaches have found better long-term success.
Yelena?
I think the takeaway is that the outlook for the market is good. It's going to be going strong based on all predictions into next year. There's good competition out there. There are good targets. From the insurer perspective, certainly everything looks like it's going to continue going well. The only thing that I would say is make sure you focus on that diligence, do that well. Like Melissa said, don't do any panic buying, and then really, really look under the hood. Don't cut any corners, and that will serve you well and go towards a successful transaction.
Great. Thank you to all three. It's certainly, I think, coming out of this discussion, very much seems to be this concept of as a buyer, stay the course, continue to be focused, take advantage of the current opportunity of the opportunities that are out there, and exercise the same sort of level of judgment. I think, Yelena, as you said, as you would have done pre-pandemic and pre-current sort of activity. So I guess with that, we'll turn it over to Q&A. We've received a host of questions through the registration process, and we also have a few that have been coming in as we had the discussion just now. but certainly please, feel free at this point to submit additional Q&A just by pressing the Q&A button at the bottom of your screen. But I will get started with the pre-submitted questions. We'll try to address as many as we can, time allowing. So why don't I start with a few of the pre-submitted ones? I guess, John, maybe this one is well directed at you. The question is really around what guidelines are used to determining value when you're selling your business.
Yeah, and I'm going to say that that's probably a better question for the investment bankers that are probably not on this particular call in terms of determining the value when selling. But traditionally, what we see is everything's based on market multiples in some way, shape, or form. I mean, I think when you get into unique situations where there is not a product, there's not revenue, you're talking about more on the acqui-hire type side. The dynamics are very different in terms of how the valuation ends up in terms of the seller when there aren't those kind of market-based processes. But I would say a lot of companies, to the extent that there are revenue and EBITDA and the like, and it isn't an acqui-hire or something, that you just look to the market multiples as an indication and then go from there.
Great, thank you. And then moving on, maybe Melissa, this one maybe in your wheelhouse. The question is, does it matter in which state the target is incorporated?
Very little. It matters. The lawyers will care and will spend a little bit of time on it. California is a little more complicated than Delaware. You'll add a little more complexity, but none of it's a non-starter. So I wouldn't let it keep me up at night one way or the other.
That's helpful. And maybe also similar along the lines of what you mentioned previously in this discussion around the complications of dealing with PPP loans in documentation. One of the questions that came in was whether having a PPP loan was sort of a red flag if you are on the sell side.
It's not at all a red. Well, it's a yellow flag. It will absolutely come up. And you and the buyer better have very clear expectations on whether it's getting deducted from the purchase price or not, because you probably both have a view and it may not be the same view. And that may be enough money that it really matters in the overall scheme of the economics of the transaction. So I think if you have a PPP loan, surface that early and make sure you're very, very clear on what the treatment of it is. But they are generally small enough magnitude in the grand scheme of things that the worst case scenario is it's a deduction from the purchase price. It doesn't tend to blow up deals.
Got it. Okay.
Melissa, I think that's an interesting point. And I want to just understand a little bit more, because in my experience, what I've seen is very few instances with PPP loans, but a couple of the advice that I've seen given to sellers or in the negotiations is have the seller settle it before close, so it no longer becomes an issue.
Well,
and I'm curious to see what you're seeing happen.
Yeah, like that's a great theory, but to settle them, you have to get them actually forgiven, and they're so backed up there, and there are so of the percentage of loans out there right now, so few have actually been forgiven. And the forgiveness process is not a week, it's 60 days, 90 days, it's slow. Again, this is a very rapidly evolving topic, and there are new provisions where you can put the funds in escrow. And so that's a way to not deduct it from the purchase price and try to get through, try to not have it deducted, but try to also have the buyer be protected. Some buyers will do that. But it is literally every week it is evolving in what's happening. The banks that gave the loans don't understand them or what the forgiveness process is. They are generally triggered by change of control. So remember, you will need a consent from the bank, or if you don't get a consent, you have probably defaulted on the loan, and that's a separate issue. So again, none of these are insolvable. The lawyers are talking about them all of the time. There's generally a path through the wilderness, but it is clearly an area of sensitivity. The seller doesn't want to give up the funds. Buyers feel like they have reputational risk. It's moving all the time, except that it's moving really slowly for the banks. So, it's tricky waters to navigate.
And I must chime in there, because true to form, the insurers spotting a new risk have come out with a PPP loan policy. So it is out there. I can't speak to this particulars, but I can get that information for anyone that's very interested. But apparently there is now a PPP loan insurance that you can get.
Solving for me today. That's great to know.
There you go. So I think we spoke quite a bit about SPACs earlier in the conversation, and one of the questions that came through on that topic was just around life sciences SPACs and whether you've seen sort of a interest or activity around those SPACs pursuing kind of a portfolio of approach of acquiring a few sort of startups concurrently.
Yeah, absolutely. So I've definitely seen that, and actually had a separate webinar just devoted to the topic of life science SPACs. So definitely an area of interest to folks. It's it's interesting area. It definitely something that is available for coverage from an insurance perspective. There are a number of insurers that are covering healthcare and bio tech and life science companies. The quirks come in terms of coverage of things like, Medicare and Medicare reimbursement have actually been covered, and there's some elements to that are a little tricky, but they're not entirely something that needs to be written off. You need to start looking, though. The difficult areas would be around HIPAA and like that privacy protection situation with those. And I think the last bit there is that the medical malpractice piece, that is something that I think is still off the table. That's just not something that could be coverable. But it's definitely an option, and I've seen it for SPACs, and I've seen it from the insurance side as well.
And Yelena, since we're discussing that topic and the insurance topic, one of the questions that came in was just around giving a ballpark of how much a startup may need to set aside for rep and warranty insurance. How would you think about that?
Great question, right? That all comes down to how much do these things cost, right? Absolutely. No, absolutely. So I would say, again, it depends on the limit that you are buying, right? So for example, if your deal is not extremely large and you want to go sort of for the minimal $5 million limit in coverage, the pricing currently is somewhere between 2.5 to 3.5 or so % of the limit. So that's like 2.5 to 3.5% of the 5 million. So somewhere, if I'm doing my math super quickly, around 150,000 or so in premium. So if that's the number you're looking at, that's how much your policy would cost. In addition to that, the insurer typically charges about 30 to 50,000 to cover the diligence process, which is they pay to their attorneys. And so all in all, I think you're looking at about 200,000 or so in costs. If the premium, if the limit you're looking at is around 5 million or so.
Okay, thank you for that. And one of the we've spoken a bit about the diligence that the buyer is conducting on the target earlier in this conversation. One of the questions that came in was, how should the target be thinking about diligencing the company that would be acquiring them? Any thoughts there from the group?
I think it depends on what they're buying with. So if they're buying with stock as currency, you'd better know a lot about who's buying you. And you get to do, what we call reverse diligence. So you look more deeply into what's going on. If it's cash on some level, it's sort of, can they pay or not? I will say an interesting trend for me is buyers have always been focused on target culture. I have recently seen a lot more emphasis about targets focusing on buyer culture, which I think is great. I think it's really interesting, and I think it's a question that has come up more on the front end of conversations and more directly. Because although, the company is really just trying to, from a corporate perspective, is trying to maximize stockholder value, the reality is this is often changing the lives of the founders and the employees, and it's going to be a pretty big change in their lives post-transaction. So I think it's often looking at the reputations of buyers, how good have they been at integrating prior acquisitions? Have they have people come over and stayed for 3 weeks and left, or have they stayed and moved up the hierarchy and you run into them 10 years later and they're passionate converts? So I think there's, again, I think there's a couple of different layers, and one is really just about the diligence for the transaction itself, and then one is a sort of broader cultural fit question. Yeah,
no, that makes perfect sense. I mean, certainly from an HR standpoint, management going over, you do see a lot of those dynamics around, is this a place where the management team wants to join and sort of commit to being kind of longer term, and obviously very transaction specific. Another question coming in, I think this group touched on some of the components here, but maybe just asking it in a broader way. Kind of what are some changes coming up from a regulatory, tax, and other standpoints that you see having an impact on M&A activity? I know, John, you mentioned earlier kind of the elections and questions around tax on a go-forward basis. Are there other things that are coming up from a regulatory or otherwise standpoint that you see impacting the thinking on M&A?
If that's to me, I'll actually defer to maybe Melissa from a regulatory perspective. I think tax is kind of the big one, but we talked a little bit about cyber, but I'm sure that there's some other ones from a regulatory perspective.
Yeah, it's funny. I was actually just internally, we were talking the other day about putting a panel together. I think the big question is who wins the election. I think that will change a lot of these questions, a lot of these questions one way or the other. But I think, stepping back, there is, you name the regulatory regime, it is probably getting more important and not less important over time. Privacy is incredibly important, as we discussed before. But again, I mentioned before, CFIUS, which was sort of a postscript on a bunch of deals before, has really caused some issues in getting deals executed, and people are actually looking at the nature of the buyer now in a way that they didn't used to. I guess backing up to the diligence point, you should figure out if you're getting bought by a foreign buyer or a domestic buyer, because that doesn't matter for deal certainty. Yeah. So I think, this is very industry specific too, right? Like, it depends on who regulates your industry. If we're talking about life sciences, this is an entirely different regime than if we're talking about tech for the most part. But broadly speaking, it is certainly, they are all evolving rapidly, and some will evolve more rapidly than others. Things like privacy are such a patchwork right now. I think hopefully at some point it settles down to, instead of a patchwork quilt of state by state, to a more consistent regulatory scheme, but nobody has any idea if and when that's going to happen. I think we're all very confident that it will be in flux and it will change. And again, it depends on how good your crystal ball is in terms of which specific issue to keep your eye
on. Fair enough.
And I just want to add one point to that. From where I'm looking at these deals, and it becomes very interesting to see the ones that are in the sort of more regulated industries are the ones that have to get those regulatory approvals, and especially the ones like cross-border ones where regulatory approvals need to come from some foreign entities, have been taking a lot longer, perhaps due to COVID. And so that period between sign and close has just, on some of the deals just grown and grown and grown. The insurers have adjusted. They are offering typically, 90 to 120 day cover for the, between the sign and close period, without any additional premium. But I've seen some deals that, were going out longer than that. And so that could create some additional issues that you kind of didn't anticipate.
Maybe then just moving on to our last question, and I've seen a few questions come across on this topic, so I'll try to amalgamate them in the interest of addressing the topic generally. And that's around financing. You know, I think we've spoken a little bit about the interest rate environment and how it's favorable to M&A activity, and certainly for large cap, acquirers who have the funding, it certainly makes a lot of sense. But maybe if we want to talk a little bit about smaller acquirers, earlier stage companies that are looking to grow inorganically, but may not have necessarily the resources of the larger cap companies they can borrow very cheaply. How are you seeing the ability for smaller companies to finance acquisitions evolving? Is that a pretty open market? Is that contracting? Kind of what are your thoughts there? And it's a general question for the group, whoever feels like they've seen some trends here.
Yeah, I think when you think about smaller businesses and the more growth businesses in terms of financing, what I typically see is them going back to their boards and their existing investors and coming up with opportunities. I mean, when I work with some of my growth investors, so they're making the larger checks in the CDE series, they're open to that, and they'll have those conversations, and that's part of the thesis about raising capital and doing another round or helping them finance an acquisition in one way or another, because oftentimes those companies don't have the balance sheet to go out and do it themselves. And the debt side of it isn't really what companies go for. That's more the private equity, where they care about the leverage and it's a financial return kind of model. When you think about the smaller companies, it's more about the operations, the people. And so they'd rather do it with capital than debt.
No,
that's at least been my experience.
No, I think it's honestly the capital markets have been surprised. Maybe I just don't follow anything, but I was equally surprised by the capital markets and the access companies have continued to have to capital markets. And so I think there's some companies who haven't had to do financing because they've been able to sell equity on the capital markets, turn that into cash, and use the cash for an acquisition strategy.
Fantastic. Well, wonderful. Thank you so much. And I'll turn it over back to you, Nicole.
Amazing. Well, thank you all so much, not only for these insights, but for all of you for joining us today. We hope that the last many hours have been both inspirational and insightful around the M&A process and getting some up-to-date details on how one can be successful in a very challenging year, no matter what. We really appreciate everyone's expertise and guidance that have participated and contributed in the conversation and the dialogue. And as an ask for all of you joining us, please take a moment to share your feedback that will help us continue to get smarter and also stronger in how we present this type of content for you in the future and in the coming months. So please follow that link that you'll see in the chat and give us your feedback if you have just a moment or two. And lastly, as a reminder, as you saw at the beginning and throughout today, our big commitment to all of our entrepreneurs in this time is to really unlock the intellectual capital that lies within all of us through the art of mentorship and to really make it more distributed to our businesses in need right now. Our goal over the next 12 months, 1 million mentor hour to more than 50,000 diverse businesses in this country. We're not going to be able to do that alone. We need each and every one of you to be able to contribute, to nominate, and to recognize the importance of mentorship and the difference that it brings in this world. So please, if you haven't yet joined us in the movement, either recognize someone who has made a difference in your life through mentorship, tag a mentor through our social campaign, or alternatively, if you will, consider being able to join up in responsive mentoring for our businesses. We deeply appreciate that. And of course, if you're an entrepreneur in need right now of some support, please know that we're here for you, and you too are equally welcome to please sign up and join in on this opportunity. So again, thank you so much, all of you, for joining us. We are incredibly appreciative of all the support that you've given us, and we will look forward to seeing you all soon. For now, we're done with M&A.